What's going on, everyone? Steve here with IBC Global. In today's video, we are going to talk about why whole life insurance is often misunderstood, and a little bit about me and our company. What our company, IBC Global, does is set up policies for maximum cash value. Why people work with us is often A, because they're interested in a whole life insurance policy for high cash value, but then B, they want to make sure everything is done right. And that has to do with the initial setup with respect to choosing the right company, choosing the right product, setting it up to be very flexible, and then ongoing guidance and support, helping individuals use the policy, whether it be for loans, retirement income, making changes, whatever it might be. That is really what our company specializes in. So with that said, let's get on into it and have some fun. Why whole life insurance is misunderstood. So there are a lot of mixed opinions about whole life insurance when you look at it. One, we've got here what we like to refer to as the herd mentality. When it comes to whole life insurance, have you ever heard any of the following? That it's a bad product, that it's expensive, that the cash value has weak returns, or you're going to have buyer's remorse. If you take this policy out, you are going to regret it. You're going to feel ripped off at some point down the road. Have you ever heard any of the following? You may have heard all of them, and we may have heard it because one, there is a lot of misinformation out there, there's mixed opinions, but two, could also be true. What I'll say is if you start a whole life insurance policy and it is not set up right, it can be a very, very bad product where a lot of people have gotten policies like this and they have felt like they were scammed. That's what they expressed after they started the policy. And a lot of times they let it go, they lapse it. So we hear that frequently about whole life insurance, that it is not a good place to put money. But then at the same time, we hear of people putting boatloads of cash into these products, particularly wealthy people, banks, corporations. So when you look at the 1%, banks, and smart individuals that really understand how whole life insurance works and what it should look like and also what it should not look like, that's where we see tons of cash going into these policies. Again, the goal here is not a high death benefit in most cases, is to maximize the cash value. So we see someone putting in $100K per year or $1 million per year or even more than that, and we say, okay, why? Like, why on earth is someone or a company putting boatloads of cash into these policies? Give you a quick example of a very large policy. This is a bank we work with, and they made 2 deposits. So on the far right, we see a total of $20 million they've deposited thus far, and they made one purchase in 2020, another in 2021, and they're almost at the maximum capacity as far as how much money they can put into life insurance. They've got a little bit more room, but why they were interested in it is for the cash value benefit primarily. The death benefit is attractive. I remember speaking with the CFO about this, and he said, yeah, the death benefit, that's all well and good, but we're not really counting or we're hoping that none of our employees die anytime soon. We don't want that to occur. The cash value is what we're interested in here. So we see the $20 million deposit. Here's the cash value, and then also the death benefit figures. These are the combined values. These values have updated a little bit since we started these policies, but this is what they did. And this is an actual bank that we work with. Now, this is a smaller bank. If you were to look at some of the mega banks in the US, they put a lot of money into cash value life insurance. So here are some more recognizable banks in the US and the amounts that they have in cash value life insurance. So you've got Bank of America. They're a little over $24 billion in cash value right now. It's $24.1 billion. You've got Wells Fargo at $19.5 billion. Then JP Morgan's right about $12.3 billion. And this is all in the cash value holdings of their policies. And by the way, you can find this information on the FDIC website, where they do have to disclose this information. And just to add a little bit more information to this, let's look at the biggest one, Bank of America over here. $24 billion in cash value. That's a lot of money. That's the cash value piece. This is a life insurance policy. When you look at bank-owned life insurance, the death benefit, which is the amount of money that's paid out for a bank when their executives and employees die that they have life insurance policies on, the death benefit is on average 2 to 3 times whatever the cash value is. So that could be about $70 billion in death benefit proceeds that are paid out. And the death benefit's paid out income tax-free as well. So that's a ton of money going into the product for the cash value now, because it's a safe area that can position money that just continues to appreciate over time. And from a long-term perspective, that is a lot of cash coming back to them as well. So we see that banks put a lot of money into the product. And it's not just banks. Quick story about Doug the doctor here. Years ago, when I was working at another company, a doctor walks into the office. He has a meeting with 2 agents at that office. One was the owner of that office. The doctor had read a book about cash value life insurance. From what I recall when I heard this story, he throws the book on the table and says, I want to put $100,000 a year into a whole life insurance policy, and he was interested in the cash value. That was his point of interest. So they sold him a whole life insurance policy where he paid $100,000 per year into the product, and here's what he was sold. So he's paying $100K per year in. What do you notice here? Base premium, that's how much he's paying. $100K per year. Total funding will tally up all of his payments. Pretend this is you. You pay $100,000 and your first year cash value is $3,500 and change. Are you satisfied with that? Because that's almost a $97,000 loss in the first year. Second year, you make another $100K payment. Total out of pocket is $200,000. Your total cash value is $106,000. As we continue to make payments, paid into it for 10 years, by year 11, you finally get your money back, meaning you saw no growth on your money, looking at your total payments, during the first 10 years. It's year 11, you barely see a gain on cash value there. And he was interested in the cash value. This is why we often hear people express that whole life insurance is a bad product. It's expensive, has weak returns, going to have buyer's remorse. This is why when I speak with individuals and ask them if they've seen or been presented whole life insurance in the past, they often say yes. If I ask, did you move forward with it? A lot of times I hear, no, I didn't move forward. I ask why. I can't quite remember. On the illustration, do you remember seeing you paid a lot of money in, you had a big death benefit, but the cash value was next to nothing in the first year, and it took a long time to get your money back, like what you see here? Yeah, that sounds about right. So when people are interested in the cash value, and they see this, that's often when they hear that it's a bad place to put money. Does that make sense? All right, cool. So next, let's look at Doug and what could have been done. We're going to look at the exact same product with the exact same company and the exact same out-of-pocket to him, just set up differently. So what Doug was sold is what we just looked at on the left. Let's cross this out, meaning we don't want to do this. To the right, again, same company, same product, same out-of-pocket to him. Annual funding is what he's paying, $100K per year. Look at the cash value. Instead of $3,500, he's at just about 88% in the first year. When we look at what's highlighted in yellow, that represents when he gets his money back. It's between years 3 and 4 in this example. Now, why there is such a difference here, because his out-of-pocket's exactly the same, is this guy right here. So of the 100K, instead of having 100% of his money go toward the insurance premium, we've got 10% going toward the premium. This actually includes the base premium and a term insurance rider in this specific example. We've got other videos that go through a detailed breakdown of that. And then we've got this PUA rider. PUA stands for paid up additions. I like to refer to this as a cash dumping. Why I like to call it that is because we're dumping money into the policy and we see it show up in cash value. It's how we accelerate the cash value growth. But a world of difference there. This also creates a lot of flexibility, because what you can do with a lot of companies and products is set it up where you're committed only to the premium, and then the PUA piece can be added at your leisure. Not all companies are quite that flexible, but my point is we can set it up where we're not on the hook for $100K every year. And the same is true if you're paying $10K per year, $1 million per year, whatever it is. We can make it very, very flexible there. So what we're looking at here is one product that's set up in two much, much different ways. Pretty interesting, isn't it? And when we look at the far right, this simply shows how much more or less you have in cash value with the option to the right compared to the option to the left. Your out-of-pocket was the same. 10 years into it, you've got almost $200,000 more, and you see the gains or the increase just continues over time. And this is after you stop paying. So this is the difference there. And this is, in my opinion, why whole life insurance is often misunderstood, specifically when one is interested in the cash value benefit. So I do hope that you enjoyed this video. I hope that you found it informative. If you have any questions, please let us know. If you're interested in connecting with us and checking out any high cash value policies, please check out our website, ibcglobalinc.com. On the website, you will see how you can work with us. People that typically work with us are those that are interested in whole life insurance for high cash value, and they want everything set up right from the get-go and ongoing guidance and support and service as well. If you're not ready to start a policy, that is perfectly fine. I hope these videos are helpful, and we will talk to you soon. Hope this helps. Thanks so much. Hey guys, Steve here with IBC Global. Thank you so much for watching the video. If you're interested in a whole life insurance policy and you'd like to work with our company in setting it up, please visit our website, ibcglobalinc.com. We would love to work with you. If you have any questions, please leave them in the comments below. And as always, I hope this helps.